Hi everyone. It's an absolute delight to be here. I've watched all the sessions this morning and I've learned a huge amount. So hard acts to follow, but here we go. We're going to pack a lot into this session because we're going to be talking about what's going on out there in the economy and how that affects the way that you save and invest. So all morning we've been hearing about why saving and investing is a good thing that we should all be doing. We should be trying to put what we can into a pension, not stressing out too much if we can't put a huge amount into it. But so long as we do keep saving into a pension, that's great. And we've heard about the importance of just saving and investing it. And as Vivi said earlier this morning, just do it. But you might be thinking, well, okay, we should just do it. But how do we do it? And I hope I can shed some light on that today. Now, I started my journey into investing a few years ago. And whilst I realized that a little knowledge about investing can be a dangerous thing, and trust me, when you see some of the Bitcoin bros online, they really do display a little knowledge. Actually, learning something about what's going on out there is better than not knowing anything at all. Having some curiosity about what's going on in the stock markets and in the economy and how that affects our money is really important. But the irony is that as you get switched on to the idea of investing, you want to know more. You become quite addicted to that flow of information. And that's something I can definitely testify to. In my book, I share my investing diary, and I talk about how my family needed to stage an intervention when I got a little bit too addicted to one of the free trading apps that's out there. I came through that phase. I'm now in recovery, you'll be glad to hear. But as you go through your investing journey, you might get into a phase of becoming quite addicted to the information that might affect your portfolio. And the more that you know, the more you'll realize you don't know, which can feel quite bewildering and frustrating. And it comes back to the points that were being made about imposter syndrome as well. You'll always feel like an investing imposter because frankly, everyone who talks about investing is an investing imposter because there's so few right answers, there's so few certainties, there's so few guarantees. And it's one reason why when you start your investing journey, you'll be presented with a choice, broadly speaking, of which approach to take. Should you go down the passive route? Should you be a passive investor or should you be an active investor? And one reason why people tend to go for passive investing is because they feel that being an active investor requires a lot of time, requires a lot of effort. It requires you to stay plugged into what's going on in the world economy. And people think, well, I kind of just want a simpler life. I'm a busy woman. I've got stuff to do. I'll just go for the passive option. And that often means picking kind of off-the-shelf options that are offered by digital platforms. There are so many more today than there used to be. And the decisions seem to be made for you, what's not to like. And the investment decisions are automated. Again, what's not to like. But the thing is that whilst that saves you the anxieties of being an active investor in some ways, when you're making all the decisions about your investment portfolio, yeah, you might wake up at 3 a.m. thinking, oh my goodness, what am I doing with my money? I've got some bad news for you. You've got to engage with the world of money, whether you're passive or active, even if you would prefer to be pretty hands-off. Once you take the plunge and decide that investing is the right thing to do, and I would argue it definitely is, then you've got to engage with what's going on out there. You'll still be faced with a lot of choices as well if you choose passive investing. It's not like going for that option means you don't have to make any decisions because there's all sorts of different tracker funds that you can choose from, and you have to understand what those different tracker funds are and what they can do for you. And look, professional money managers, what they do all day long can seem very intimidating and daunting to lots of us. They spend all their days glued to screens, devouring information from all over the globe, discussing it with their teams, talking to analysts, talking to companies, crunching numbers, assessing risks. Even if we wanted to do that, which I don't think any of us really want to, we wouldn't be able to. We just wouldn't have that kind of access to information that money managers have. So really, we need to try and aim for a need-to-know basis when it comes to the world of money. Yes, we could choose to spend all day, every day, reading the Financial Times, getting up to speed with what's going on in the stock markets in Japan, China, Brazil, goodness knows where. But actually, we just need to understand what's going on and how it affects us. And so that's why we need to be following the news, keeping an ear to the ground as to what's going on in terms of the economy or stock market. Now, some of the most successful money managers in the world, like Warren Buffett, for instance, they think a lot and they talk a lot, but actually from month to month and year to year, they do very little. They come up with their strategy and then their portfolio, and they leave it alone. Now, the standard advice that you will often hear is, that's what you guys should do. You should follow Warren Buffett's example. You should just set your strategy, not think about it, and not worry about it for 20 years, and hey presto, you'll have a fantastic nest egg at the end of it. Well, if only it were that simple, right? As I said previously, it's very easy to get embroiled in the world of the stock markets and start thinking about how it affects you. And it becomes very, very tempting to tinker and tweak with your portfolio. Even when you think you've come up with the right strategy, once you get some news that seems to contradict some of the original assumptions that you made, it can send you into a bit of a spiral. And that's not to say that making some changes to your investments over time is not the right thing to do. Because you'll change, your goals will change, your life will change, the things that matter to you will change. And so perhaps your investments do need to change along the way. So there's nothing wrong with having a look at what you're doing every 3 months, every 6 months, every year at least, and just making sure that your portfolio is diversified, i.e. that it's spread across a good range of companies, of sectors, regions, and that has a different number of styles in it. And that you're not paying too much in charges, because charges really eat into your returns. Those things matter, and you should definitely try to review those things. But unfortunately, once you start investing, you won't just stick to 3 months and 6 months and 12 months, especially if you have your investment account on your phone. The temptation will be to check it a lot more often than that. So hopefully by the end of this session today, I'm going to convince you that that's not the right thing to do, and that maybe just leaving your portfolio alone, however difficult that may be, is the right thing to do. But let's take a step back. Let's have a kind of think about what's been going on in the world economy and how that might affect our investments. So let's rewind to 2008, the time of the great financial crash. If you're a millennial, you'll remember this as a wonderful time where we were graduating into a jobs market where opportunities were plentiful and housing was cheap, and we could all achieve financial independence with no problem whatsoever. Of course, that's not what happened. It was a very, very difficult time. And then came the great interest rate crash. So base rates, as I'm sure you guys know, or maybe if you don't know, these are set by central banks, and they're there to try and keep the equilibrium in an economy. That's how I would put it. And of course, once you have a financial crash, central banks have a look at their interest rates and ask, what can we do to try to get the economy moving again? And what the central banks did was to drop the base rate down to a record low. And what that does is it frees up money for companies to borrow cheaply so they can grow. It also frees up money for people to borrow so they can spend. And so as a result, we saw this great boom in assets like mortgages. It's one reason why the housing market has gone gangbusters over the past 15 or so years. And it ended up injecting a huge amount of money out there into the economy. You might say, well, not a lot of that money reached my pocket, and that's the point. Kind of created a lot of inequality. It was great for the stock market, great for the housing market, great for people who already owned assets, not so great for people who didn't own assets. So there became this great gulf, I suppose, between people who were asset owners and people who weren't asset owners. And hopefully it also concentrated the minds of the people who weren't owning assets and helped them realize maybe we need to try and get a stake in this economy. Then we had, of course, COVID. That was the next big economic shock, and the great lockdown experiment after that, where the economy was effectively put into an induced coma. And since then, of course, once lockdown ended, people went back out, worked and spent and saw their loved ones and ended up injecting a lot of activity back into the economy. Unsurprisingly, that contributed to inflation, not helped, of course, by the war in Ukraine. and the squeeze on energy supply and commodities as well since then. So the central banks were faced with a new dilemma for, 15 or so years. Actually, the base rate had been at that record low, and inflation had been pretty low as well, comparatively speaking. Suddenly, inflation was on the rampage again. So what do central banks tend to do in that situation? They put up interest rates. Why did they do that? Well, if you make borrowing more expensive, then people are not going to spend as much, companies are not going to borrow as much, and therefore some of that activity cools down in the economy. So there is a rationale to it. The problem is the pace at which this is done. If it's not done at the correct pace, it can end up triggering economies and putting them into recession. And that's the kind of balance that the central banks have been trying to achieve, of bringing down inflation without triggering recession. We haven't quite managed it in the UK. You guys might have seen that we saw in the last quarter that we technically entered a recession. But what we have also seen is interest rates going up to now over 5%, but that has happened in a very, very short space of time comparatively, because if you think about the base rate being nearly zero for 15 years, it's quite astonishing that in the space of just a couple of years, it's gone from nearly 0 to 5%. So the long and short of it is that this has had a very, very dramatic impact in the short term on the investment outlook. And the funny thing is that if you go out into the street right now and ask your average Joe or Joanne, what do you think is going on with the economy right now? What do you think the outlook for the economy is? You'll probably get a very negative, pessimistic response. People will feel very, very gloomy about the economy, both here and in America. But actually, the US stock market is at an all-time high, and the FTSE 100 is now higher than it was before the pandemic. So what's going on? Well, I think this illustrates a really important concept in investing that we've all got to get comfortable with, which is that actually a lot of the time investing is not based on what's actually going on at this very moment in time. It's about what the markets think is going to happen. Now, whether that actually happens or not is kind of up for discussion and debate, and very often what the markets think will happen isn't what happens at all. That's what makes investing frustrating, but also really fascinating. And it's why actually you're as entitled to your views about what might happen as the experts out there, as those who are writing in the Financial Times, as those who are talking on Bloomberg, as the money managers, the fat cats in the suits. They've all got an opinion, but so have you. And if you keep in touch with what's going on, your opinion may turn out to be correct, and your opinion might turn out to be more accurate than the experts, which I think is really, really amazing. So let's have a look as well at how this has affected different parts of the investing world. So if you think back to 2020 and 2021, we were all stuck online. We were all having to do Zoom parties, which are just absolutely horrendous. Let's never go back to Zoom parties ever again. But what that illustrates is that we became very dependent on tech. And so at that time, we saw peak FANG. Does anyone here know what FANG stands for? No? Okay. Facebook, Amazon, Apple, Netflix, Google. What have all those companies got in common? Well, they were all tech companies, became unicorns very quickly. Unicorn means a company that's valued at over $1 billion. These are companies that people wanted to invest in when interest rates were low, and therefore it was quite cheap to borrow money and to take a punt, because these companies look like the future, and to many people they are still the future. But it's quite easy to invest in those companies when money is cheap. And we can add to that group as well, Tesla. But unfortunately, Tesla doesn't work quite as well with FANG, because otherwise you have to say to-FANG or fanked. So yeah, it doesn't quite work, but you get my point. Now, over 2020 and 2021, we reached peak FANG. Anyone who invested in those companies, as many people did right throughout the 2010s, made a huge amount of money. And I think for a lot of those people, they thought those good times were going to continue. And let's face it, we are still all using these companies an awful lot. But actually, at the end of 2021, shares which had been in fashion since the financial crash nosedived. And that was because the markets were starting to look ahead, and they realized that actually inflation was about to go up and interest rates would also have to go up in response. So it gives you an idea that actually just when you think that there's a certain paradigm within the stock market or within an economy, when a status quo is set to continue, that something can come along and change that. Often it's a black swan event, an unknown, as Donald Rumsfeld once referred to it. Or it can be something actually that lots of us did see coming, like a pandemic, but that we were just not very prepared for. And when that happens, certain companies that have been doing really well suddenly don't do so well. And other companies that have been doing terribly come back into fashion. So the companies I've just been talking about there are often described as growth companies because they're all about growth. There are another set of companies that you can invest in called value companies. And I like to think of this as rooting around in the bargain bin of the stock market. And it's a little bit like, for me recently, I've booked a wild swimming retreat because I have turned into that person. And I have to find a kind of changing robe for when I get out of the sea because it's March in Cornwall, it's going to be cold. So I thought dry robes, £150, no way. I managed to find one that costs £12 online that's a dupe. Now, time will tell when I go on that retreat as to whether that particular product is going to do the business for me and whether it's going to be a bargain or whether it was cheap for a reason. And it's the same with a lot of these value companies. They may look attractive because they're cheap compared to the growth companies, but they could be cheap for a reason. So you might be thinking, okay, Iona, you've taken this through what goes on out there in the economy, base rates, inflation, growth companies, value companies. How does that all affect me? Good question. The problem is I can't tell you what the right approach or strategy would be right now. I can tell you what the experts think are probably going to happen this year because we're always looking ahead. We're always trying to anticipate. We're always trying to make an educated judgment about that. And yes, the outlook actually looks quite positive. That's why the US stock market is riding high. That's why the UK stock market's doing pretty well. It's because the experts think that we're on course for a decent economic recovery, actually, both here and in the US, even if that's not the sentiment that you'll find out there on the street. That's what the experts and the markets think are going to happen. And that inflation is going to come down. And once inflation comes down, then investing in some of those growth companies might start to look quite attractive again. Because here's the other thing, right? You don't tend to invest if savings rates are good. Because if you can get a 5% return on your money without having to put it in the stock market, better to do that and know that you're going to get that money rather than put it in the stock market and potentially lose it altogether. Because we all know that's a risk that you get with investing. So that is why at a time like this, people become a lot more hesitant to invest. They go, savings rates are finally looking good again. Why don't I just go for saving? Well, I would say I am both team saving and team investing because I think you can and should try to do both if you can. Obviously, money is a finite resource, but if you can do both, then you can have your money for short-term, easily accessible goals, ideally about 3 months worth of outgoings in an easy access pot should do the trick. But then beyond that, when you're investing for the long term, when you're investing for your goals, or as I prefer to think of them as dreams, because Gloria Steinem once said, dreaming is a form of planning. So if you've got dreams, that's you still planning for your future. And you can invest for those dreams because investing is by nature a long-term pursuit. And we've heard today about the importance of thinking about what gives you joy, what you would like to work towards to achieve your life's goals, what things you'd like to do that won't give you any regrets. These are all really important things, but it's also so important to think about future you, to think about where you want to be in another 30 or 40 years' time. It seems like so far away, but hopefully it will come and you want it to be awesome. So I think I'm not going to spend too much longer telling you about what's going on out there in the world economy, because I think what I've hopefully done today is to give you a flavor of the uncertainty, of the volatility, of the fact that sometimes your investments can be doing well, other times they won't be doing so well. But that's kind of not the point, because investing is long-term. This is about you investing for the future. So I would say the basic principles that you can take away from today, if you're starting investing or you're fairly new to it, or you've been doing it for a few years and you're maybe thinking about resetting stuff, is by all means, keep up to date with what's going on. Have an understanding, an informed understanding about what's going on out there in the economy. Because apart from anything, it's fascinating. It affects all our lives, regardless of whether we invest or not. And by all means, have a look at your investments every 3, 6, and 12 months, just to see that you've got a nice spread of investments across different regions, sectors, and markets, and that you're not too heavily concentrated in one style of investing. You're not just going all out for growth, and you're not just rooting around in the bargain basement of the economy. You're going for both approaches. But don't get too caught up in the noise. Don't get too influenced by what you see out there online, particularly in the age of social media when we have all this information coming at us 24/7. The most important thing is to just remember that actually, to slightly paraphrase Ronan Keating, you do it best when you do nothing at all. So I think I'm going to leave it at that. But I'm going to be signing copies of my book upstairs if anyone wants to come and pick up a copy, because it tells you about not just the why of investing, but also the how of investing in a lot more detail than I could go into today. But hopefully I've given you a good overview. Thanks very much.